Good Tuesday afternoon to you. Welcome to the Jon Sanchez Show on Newstalk 780 KOH. It's a pleasure to be with you and a pleasure to be with my co-hosts. Around the horn we shall go. Dwight Millard, Highlands Mortgage. How are you, my friend?
I'm doing fantastic, John.
Wait a minute. I like this.
Corey, look at this. Yeah, I just need it. Like I said, one of these days I'll have a little fire back there and a little cognac and a cigar or something.
There you go. Looking good, man. Looking good.
It's very John Dutton.
That's right. Yeah, exactly. He looks like John Dutton. There you go. Mr. Cory Edge of Edge Realty, Big C, how are you?
I'm doing good. How are you?
Good. Very good, thank you. A little exhausted from the wild ride today as we were chatting off air, and what a man! Oh man, this volatility right now is just incredible that we're experiencing, and it just, like I said, it's, you know what's going on, guys, is we're getting these head fakes where things look really good in the pre-market session, and no problems, good economic reports today, and then as soon as that opening bell rings at 6:30, then the algorithms just go crazy and they start selling it off, and then they'll try bringing it back and selling it off, and we are in this massive rotation that we're seeing right now. But we are in such a what we call an oversold condition, and I won't bore you, based upon the indicators we look at to know that, but we are in very much of an oversold condition. So I think the bulk of this, what are we now, 4 days of selling, basically, I think very close to an end of it. So just be patient. Like I said yesterday on the show, and Jason and I said, this is not the beginning of everybody giving up on AI and technology and all that stuff. This is just one of these rotations that we've gone through a couple times this year. And I think it's, like I said, just another one. And then I think we're going to go into a nice strong rally into the rest of the year once this is behind us here. All right, let's talk about what we got on tap before right after I get the stock market side of things going. If you're thinking about buying or selling your home in 2026, again, this is for buyers and for sellers. The moves that you make right now, kind of what Dwight and I started discussing on Thursday, these moves right now are going to determine how much you pay if you're a buyer, how much you're going to make if you're a seller, how stressed you're going to be for both parties, right? The buyers and the sellers. So what we're going to be covering this afternoon with the boys is this. And that is, we're going to break down what future buyers and future sellers need to be doing today to prepare for 2026. I don't know about you guys, but it didn't hit me until this weekend. I looked at the calendar and I'm like, oh my God, it's Christmas next week. And then it's going to be New Year's the next week. And then it starts all over again, right? And so, we're coming to you at the end of the year with some of these great year-end strategies for 2026. In real life, how often are you getting people that are thinking this far ahead, thinking, all right, it's 2025. I know I'm going to be a buyer or seller next year. I'm going to start preparing right now.
Most of the time in my company, most of the time I deal with sellers that are doing that. So if a seller calls, let's say they called last week or this week or whenever, and they're thinking about putting their house on the market, the conversations I have is, okay, we're going to wait. We're obviously not going to do it this week because of what we're coming on. And we might even wait through January. And I'll go over it real quick, and these are just from my experience doing this for 30 years in this market. But the height of the market, as I've always said, is right around the July 4th holiday, peak of prices. The bottom of the market is usually right around now, but between now and New Year's. And we don't really see it start to come back until right around Super Bowl Sunday, for whatever reason.
Interesting. So in February.
And so I always tell people, like, hey, let's get everything ready, and then we'll do something with it in February, March, somewhere in there.
That's interesting. I wonder what that correlation is. I've never heard you say that before. That correlation to
it might just be like,
hey, let's get
one final party. Holiday I can think of.
Yeah, right? Yeah, exactly. Get one final party out of the way in the old house and get ready for the new one. I'd want it the other way. I'd want the party in the new house. How about you, Dwight? Same question to you.
Yeah, I mean, the last 3 years have been challenging to kind of predict that, but I think people are out actively preparing. I think at the end of the year, I mean, there's a lot of incentives right now being pushed by builders, to try to get in. And there's some big price reductions, John. So I kind of agree. I think if I come with you, I would like to have my new house to have the New Year's Eve party in. And, I just had a call the other day that said, when's too late to close by the end of the year? We're encroaching on that time right now.
Yeah, right. Pretty darn close.
But I do like, after you get through that, I do like the March and April time of the year. I think, last year was a little bit of a dud, but I think I'm going to predict we're going to get a January Fed cut, and John, we're going to get a March one. So we talked about that. So I mean, people are kind of going, well, maybe I should wait. Maybe so.
Well, let's jump right into the rate side, Dwight. I mean, 627 is where the 30-year mortgage closed out today, according to Mortgage News Daily, right? That's what I saw earlier.
Yeah.
down 2 basis points for the day.
Right.
You're getting nothing
Nothing.
after the interest rate cut
Yeah.
last week. Zero. So
Yeah.
my advice, again, you guys are the real estate experts, but my advice is, why in the world would you wait for that January or that
Yeah.
March interest rate cut? Because it's not working, right? The Fed
Mm-mm.
is targeting the lower end of the curve, the 2-year side of it. That's not where mortgages trade off of. I mean, I cannot imagine how frustrating you are, other mortgage professionals, and probably more importantly, buyers trying to time this thing, because you're
Yeah.
like, wait a minute here. We've had what's it been, Cory? One and a half rate cuts, I think.
Yeah.
And mortgage rates have done nothing but go up.
Mm-mm.
And so
Yeah.
you have to, folks, you have to understand, again, when the Fed cuts rates, it's the Fed funds rate. The rates banks charge one another. We are not seeing the rest of the rates follow along, in relation to this, like normally you do. It's just not happening based upon a number of different factors. So, again, my advice is, if you are looking for 2026, if I was a buyer right now, I'll give you my personal opinion. If I was a buyer right now of real estate that I know I'm going to do in 2026, Dwight, I would be on the phone with you. It's 3:12 right now at 3:13. I'm going, you know what? Get me pre-qualified, lock me in. I'm going to go find something, because I personally think that you could see these rates nudge up. I really do. Unless some other extenuating circumstance, creates a different scenario. But we always have that risk, those outliers. But if you're just looking, no crazy things happen, just what we're looking at right now, guys, I don't see any catalyst, right? And you've said this all along, no catalyst right now to bring these mortgage rates down. It's just not
well,
there.
and Cory's always said it. If you got the terms you like and your payment, you can. I mean, there's no sense in waiting. I mean, you run more risk, I think, of waiting than anything else. I mean, you have the possibility of rates going up, to your point. So, and that's kind of how I coach everybody. But there's just so many variables out there that these buyers are just hooked on, because they see too much information.
Yeah,
way too much.
Yeah, absolutely. Cory, real quick, before I get to the stock market side, let's talk about incentives right now. New home builders, sellers, et cetera. Are they because again, the national data is showing absolutely a weakening housing market. It is becoming a buyer's market. What are the incentives? What's the pulse on the incentives right now? Both, again, national builders as well as, existing homes.
The existing homes, the resale, a good agent is going to talk to their client about it prior to listing, but a lot of sellers don't want to deal with it until they have to. Until I get an offer in writing, I don't even want to talk about it. I want full price, and that's it. The national builders, and we talked about this a couple of weeks ago, they're coming up on end of the quarter, end of the year, end of the everything. So they are trying to clean out that inventory. I was listening to a couple, probably same Diana Olick, I think it was today, some other people yesterday. The massive rate buy downs are getting very expensive for these builders, and so they can only, and Dwight can explain better, but they only last for so long anyway when they do buy them down. So it's becoming very problematic for these builders to spend all the money, try to squeeze the buyers in, and they're having to add in other incentives to do it. And as you were talking about with rates, I'm with you. I don't think the Fed will raise rates, but the Supreme Court's going to come down any day now with this tariff decision, which that may make the bond market a little crazy. And the bond market can revolt if somebody gets in next year and artificially brings those rates down to please the president, the bond market can absolutely revolt and keep them high and raise them higher due to the debt amount.
John, and you've talked about this analogy a long time. These incentives are now a drug in the marketplace, and they want more drugs. 3.5, 2-1 buy down or whatever is not a good start rate. They want now 2.99. They want 1 point, So to Cory's point, we've created the monster, and now we got to figure out how to feed the monster.
Yep. You're right. Guys, I want to, this kind of ties into the stock market side of things. I want to share with you, I've been dying to talk to you guys about this because it happened after hours. Reported their earnings. So let me tell you what the stock did, and then I want to share with you this earnings report right to your guys' point. Stock closed at $117.57, down $2.16, 1.8%. Right now in the after hours, it's at $112.77 a share, down $4 and now $12. Excuse me. Now just moved. It's now at $112.80, down $4.77, 4.06% loss. So listen to these numbers, guys. They were not good. NAR missed by 18 cents. They did beat on the revenue. Deliveries increasing only 4% year over year. 22,034 homes. They got at Q1 of 2026 below consensus. as far as deliveries are concerned. They made $2.03 a share, 18 cents worse, as I said, than Wall Street's estimates of $2.21. Revenue down 5.8% year over year to $9.37 billion versus estimates of $9 billion. Okay, so again, we got a revenue beat. Deliveries up 4% year over year to 23,034 homes. Gross margins on home sales 17%. New orders increasing 18% year over year to 20,018. But it's this guidance. They see deliveries of, like I said, 17 to 18,000 below the estimates of 20,089 of the street. New orders, they're estimating 18,000 to 19,000. They're looking at average sales price of 365 to 375. Gross margin percent on home sales, 15 to 16%. So again, that's below the 17% they just reported. Now, here's a quote from the, one of the executives on the analyst conference call. Quote, while affordability and consumer confidence have remained challenging as interest rates moderated, we have focused on adapting to a new normal. There's your word, Dwight, as the market finds its footing. Against the backdrop of uncertainty, we will give limited guidance on the first quarter and the year ahead. In the first quarter, we expect to deliver between 17 to 18,000 homes, 17,000 to 18,000. We expect our average sales price, again, to be between 365,000 to 375, and expect our margins to be lower as typical with the lower first quarter volume, between 15 to 16%, depending upon market conditions, with SG&A of approximately 9.5%. We expect that deliveries for the full year will be approximately 85,000 homes. So, Dwight and Cory, both real quick question. What's the problem with this first quarter? Why are they guiding so low on the first quarter side of things?
Well, I think they already see the writing on the wall, John. I mean, the activity you go by, their traffic count's got to be what's driving it. We're not seeing but John, their model has shifted to unmanned model homes. I don't know if you know that.
Really?
Yeah. And I always know in my business, when I'm present, when I'm there, I have a 95% capture rate when I'm So I don't know. I don't know if their little technology experiments are working or not,
Right.
but I mean, that might be part of it. But they're definitely seeing traffic count right now is off.
Okay. Cory, anything on your part?
I think to me, I look at it and I think it's not knowing the jobs picture, right? Like this whole thing comes back to jobs. And people are we'll get into the report and stuff today and the government jobs, the amount that were lost, but it's just a huge unknown right now. So as we've always mentioned, you can bring rates down to zero, but if you're unemployed, you're not going to buy anything.
Yep. Absolutely. And now, market pulling back like it has. Again, as we've always said, people don't feel like they want to go out and spend. A, because it's Christmas and they're already spending a lot of money. But B, if they're seeing their 401k drop in value, all those little things add up, right, to human psychology and buy. All right, let's turn it over to Kristen Snow, right now, Traffic Center. Kristen. Welcome back to the Jon Sanchez Show on Newstalk 780 KOH. So Cory Edge of Edge Realty, Dwight Millard of Highlands Mortgage. All right, here's how we finished in the market. A 302 decline on the Dow, a 0.62%. Our closing level is 48,114. NASDAQ gained 54.23%. S&P down 16.24%. On the commodity side, $1.53 loss on oil. Guys, we broke $55 a barrel today. You know why that's significant? That's the lowest price we've seen on oil going back to early 2021.
Wow.
Yep. So, again, does that mean weakening consumer? Gold price is down $3.60, 4,331.70. 3 basis point loss on the 10-year Treasury yield, 4.15. All right, we're going to jump right into the real estate topic. Cory has to leave here at the bottom of the hour, so I want to make sure we get him in on one of these important points. Again, we're talking about what 2026 buyers and sellers should be doing right now. Cory, let's jump to your main area, which is what to do right now from a selling perspective. So, first point you mentioned is detach emotionally from 2021 pricing. What do you mean by that? That's an interesting point. I know what you mean, but let's hear it from you.
2020 pricing, 2021 pricing. The biggest thing, and I've talked about it a lot, and I think you guys agree, the biggest thing for sellers is to price it effectively, price it correctly. I think I mentioned a couple of weeks ago, to me, the local market and maybe national has been a little stagnant for 2 years. So it kind of is doing this rounding top, if you will, in my opinion. But people are still going back to the highest sale that was in their neighborhood, regardless of time. That just happens to be over the last 2 or 3 years, and saying, I want that plus some, because my house has new drapes. My house doesn't have green carpet. My house. And that's not what buyers look at. So you have got to be realistic. Now, I'll caveat that with, if you don't care if you sell your house, and if your agent's like, sure, waste all my time, feel free, then put it on there and see what happens.
Yeah.
But if you really want to sell the house, then you need to price it effectively. And John, sometimes that's going to be lower than the last sale because we're in a completely different market than we were 18
And
months
that's
ago.
the point. That's the point you're making is you cannot price a house in 2025 or 2026 based upon where it was in 2020, 2021 when we peaked. And that's, again, human nature, right? And you're saying great advice. Don't do that. You got to price it for where the market conditions are today.
Correct. People feel like, and it's human nature, they feel like
Yes.
they're losing money. I'm leaving
Absolutely.
money on the table.
Absolutely.
The buyer's getting a heck of a deal. Like, no, they're paying what the house is worth.
What the house is worth, what
And I
someone's
always,
willing to pay.
the way I try to explain it to people is if you're my seller, but if you were my client as a buyer, we'd be driving a heck of a bargain on your side. So you got to look at it
Both
from
sides.
both angles
Yeah.
and look at the full picture. If we're trying to sell because we need to buy a different house here and do this and this, then let's look at the whole equation of what we're doing, not just the one. Sometimes it's okay to leave $500 on the table
Sure.
and feel good about it.
Let's go to your second point, Cory, which is prepare the home like an asset, not a memory. I love that
Yeah.
one.
So buyers nowadays, Dwight and I were talking about a little bit off air, they want as turnkey as possible. They want to be able
I'm
to
seeing
move
that
in.
over and over again. I
and
saw so
be
much
done.
as leave the pots and pans.
Sure. Yeah.
Amazing.
I mean,
why is that, Cory? Why do all of a sudden everybody want turnkey?
I don't know. They're lazy. I mean, maybe
Yeah.
that's just
Yeah.
maybe that's just the cool thing right now, but they want mostly turnkey. I would say they don't want roof problems. They don't want yard problems. They don't want to have to put sod in. They don't want all these things. They will still buy the house with all those things, but it's going to be at a massive discount to what you're willing to sell it for. So prepare the house effectively like a business, like we mentioned. Maybe bring in somebody else if you want to. Sometimes sellers, and I'm guilty of it, we look at our house with a different eye than a third party.
Right.
And we think, no, that hole in the ground is great because you can do all these cool things. And somebody else will be like, no, you got to put some
That's a
dirt back
great
in that
idea,
hole.
bringing an objective third party.
Yeah, just somebody that will be honest with you and say, no, you have to remove that tile from your kitchen countertop because that went out 20 years ago.
Are you a fan? I haven't asked you this in a number of years. Are you a fan of hiring someone like Richard Lacer to privately get an appraisal done just to kind of figure out? I mean, I know that's your guys' job as real estate professionals, but to again, pinpoint, like you just said about the tile and stuff like that.
I think so. Being in the business, Dwight and Richard, I look at the same stats as Richard does, but if I wasn't in the business, then absolutely, I would try to seek out somebody like Richard, like myself, like somebody that can give me an opinion, an honest opinion. The good thing about Richard, and not that they're not all like this, but Richard will give you an honest opinion.
Yes, he will.
And he's got very good, he's going to hate me for saying this, he's got very good bedside manner. He will sit there and talk to you and explain things to you and tell you the reasoning behind it.
That's
so
right.
It's not just a piece of paper, take it or leave it.
Right. Exactly. Years of experience. Next one, plan concessions strategically, the rate buy downs, the repairs, the credits. I love that point also.
Yeah. So, and this is on us as listing agents. We need to have the discussions with our clients prior to that. We may get in a situation where people either want concessions or some buyers, depending on which market you're in, they may need concessions to qualify. So it doesn't mean you have to change your net perspective. Like I mentioned last week, if your house is for sale for 500 and someone gives you 500 but wants 30,000 in concessions, that's the same as someone giving you 470.
Mm-hmm.
The net number is the same. So what I try to counsel my clients is we're going to concentrate on the net number. If you go into it and the only thing you will take is full price, period, you are not coming down one penny, that's fine. But if you go into it as most sellers and say, hey, I'm going to ask this, but I've got some room there, so let's see what we can do. Look at the net numbers of the effects. Don't get so caught up in the word concession and think it's bad for some reason.
Right. All right. Last one, Cory. Watch the local inventories, not the national headlines. Another great point.
Yeah, and they might be mirroring each other a little bit, but our inventory right now, it's actually doing fairly well, especially for buyers. But you want to keep an eye on the local inventory in Washoe County, but also the inventory in your neighborhood. If there's 10 other models of your house on the market, you need to be priced incredibly competitive to deal with it, because the buyer that goes to look at your house is going to look at all the other 10, and they're going to know that it's a buyer's market on that particular street. And they're going to, if they have a good agent, they're going to try to negotiate very hard because they know everybody wants to sell. So
Beautiful.
Keep an eye on what's going on. And as we talked about, that may lead you to say, hey, I'm going to wait for some of this to clear. I'm going to go to market middle of summer instead of early spring, or change your plan a little.
All right. Beautiful. I know you got to get on the road, Cory. Thank you so much. Do appreciate it. Excellent advice as always. When we come back, Dwight and I will continue our discussion what 2026 buyers and sellers should be bringing to the table right now and getting ready for 2026. Dwight's going to get into the financing side of things, some preparatory strategies there. All right, let's turn it over to Jack Saban. He's got news, traffic, and weather. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of Highlands Mortgage. Again, Cory had to step out. Once again, a 302 decline on the Dow. NASDAQ rose 54. The S&P down 16 today. Futures pretty quiet right now. All right, let's get back to our real estate topic, what 2026 buyers and sellers should be doing right now. Again, great points that Cory made a little while ago, what to do right now. Again, catch emotionally from that 2021 pricing. That's so human nature to do, right? When things were peaking. Prepare the home like an asset, not a memory. Plan concessions strategically, meaning get ready. What's your plan if you're going to get asked as a seller, what are your rate buy downs, what repairs you're going to do, any credits you're going to give, etc. Watch the local inventory, not the national, just different animals there. And then decide early, sell before or after demand returns. Now, let's go to the buyer side, Dwight. Let's turn it over to you, right? What should 2026 buyers be doing right now? Number one, get the credit ready early.
John, we've talked about being proactive. Matter of fact, we did a segment, a week or so ago?
Yeah, last Thursday.
About being ready for the refinance craze. If these, and we got a couple already in wanting to be ready for that moment. So get your credit. Everything revolves around credit. We've talked about that. It revolves around your FICO score. So credit will dictate your rate. It'll dictate your points. It'll dictate your homeowner's insurance. It dictates your mortgage insurance if you need it. So it behooves you right now. If you're buying in 2026 sometime, know what your credit score is and do a full blown. Don't do a soft pull. Don't do a soft pull. You got to know what you have. If you already know it, then that's fantastic. But if you don't, you got to know it because you can start making, like you said, improvements now that will save you thousands of dollars in the.
I came across this article over the weekend. I was going to call you on it, but I didn't want to disturb you over the weekend. There was an article, I think it was Bloomberg, but don't hold me to that. And some of these FICO score or some of these credit scores, Dwight, started changing just in November. But in 2026, there's going to be a lot of changes in the way it's no longer just going to be the FICO. Now lenders have the option, from my understanding, to utilize. So can you explain that real quickly as we're talking about preparing?
Yeah, there's more competition coming in than just a Fair Isaac. They're giving us a little bit. Yeah, they're giving us a little bit of flexibility to use some other scoring models. But that's actually bringing competition.
It's going to open it up to a lot more people.
Yeah, it's bringing competition. I don't like when, and maybe, the credit scoring companies and the bureaus don't have much. I don't know. But when somebody says, hey, that's not even mine, I got to prove that it's not mine. I don't know if this will start creating some better synergy going on and scores actually improving because of the competition.
Well, the bigger takeaway is, and this is more towards what this article said, more towards the first time buyer, is they're going to now start looking at, did you pay your rent on time?
Yes,
do you pay your utilities? Right. They're going to be looking at a lot of different factors besides just the quote normal ones that FICO looks at.
Yeah, that's the new system coming is going to take, and you're absolutely correct. So you might have a marginal score, but all of a sudden they bring in your rent history.
Yep.
That'll go up. And they've been talking about that for a long time, trying to bring those other sources in to the reporting. And, some of the rental companies participate, so you're getting some of it now, but it's not consistent. Right. So you're right. This will be interesting to see what it does.
Well, the FHFA stats indicated, according to this article, that's why I want to reach you because again we touched on this, on Thursday, but they're saying, I mean, literally it could open up, or I guess open up is a fine word. I think it was 1.5 million to 2 million people that right now could not qualify for a home under the traditional FICO model, that now with this new, what are they calling it? Name escapes me.
Yeah. I don't know. We talked about it. I'll look at, but
look it up at the break. But
but John, it's to your point. It's going to give people the ability through a scoring model they couldn't traditionally have.
And again, back to the competition that you and I discussed on Thursday. Please pick up the podcast if you missed that. It was a great show talking about, again, we think there's going to be a massive refi boom next year. And if that's the case, you better start preparing now, because as Dwight said, there's 30,000 less mortgage professionals in the industry now than when there was at the peak of the market a few years ago. And so if there's this major refi boom, you could be waiting weeks, months, maybe, to get in to see your mortgage professional. And now with this new credit scoring, opening it up to, again, million plus new potential borrowers, I think you're going to have one heck of a year, my
John,
friend.
it is amazing how many mid 20-year-olds are out there with no car loan, no credit card, but they've been paying their rent on time for the last 5 years.
There you go. Yeah.
Right?
Yeah. I love it.
I mean, they just didn't believe in credit.
Yep, exactly. All right, so let's go back to what do we do now? All right, so you said get the credit ready early. Again, I love your point, Dwight. The small fixes could literally save you tens of thousands of dollars later. Build optionality. What do you mean by that point?
Well, I mean, make sure you have some cash. I mean, right? It's going to you're going to need a down payment in most cases. You're going to maybe in some cases have to outbid or be stronger than the other one. So, John, we've talked about this. One of the things that you could have right now is a HELOC. If you have an existing home you're buying, just be prepared. Make sure if you're a first time home buyer and you don't have the funds, make sure you've talked to mom and dad, grandma and grandpa. Make sure you know where your money's coming from, and then pre-approval always matters. And I can create the scenario, John, to get you approved based upon what we think it's going to look like. So you don't have to have it all in place right now for me to give you the approval or give it to your realtor or give it to a builder. I just need to know what it's going to look like when you're ready.
Yeah.
Yeah.
And let me remind everybody again, hopefully most of you have had a pretty good year in your 401ks. And if you're, to Dwight's first point, if you're looking for cash, like how in the world am I going to come up with a down payment? Remember, I am not a big advocate of borrowing against your 401k unless it's for a very valid reason. But if you do have a 401k, let's go over the rules once again. You can borrow up to 50% or $50,000 of your 401k, whichever is less. You can select a payment option as far out as 5 years, right? So if you need some of that down payment, closing money, etc., you may want to consider borrowing from your 401k. Now, remember, whatever you borrow, say you borrow $30,000, that 30,000 is not working for you in the market. The 401k custodian basically sets that money aside. So it's not working for you, but you are paying yourself back. And as prime comes down, usually your rate's going to be prime plus 1.5 to 2 points. Just check with your plan provider. They can tell you what the rate is. And again, you're paying yourself back with after-tax dollars. So you will have less money coming home in your paycheck every week or 2 weeks, however often you get paid. But again, you're paying yourself back. So it's a very viable option, right, Dwight, as far as coming up with down payment. And remember, IRAs, again, even if you're under 59 and a half, the traditional age where if you take money out of an IRA, you get hit with that 10% penalty. You can take $10,000 out of your IRA under age 59 and a half and avoid the 10% penalty. It'll be taxable, but you'll avoid the 10% penalty if you're going to use it to purchase real estate. So you take that, Dwight, you take all the great programs that you offer, like you said, there's different grants. There's all kinds of things to come up with. But folks, it starts. I cannot emphasize this enough. It's going to be a crazy year next year in real estate with these rates coming down. It starts by picking up the phone and calling Dwight. He'll give you his number when we come back from the break. Calling him, let him run the credit, the soft credit. Let's see if there's any problems. If there are, I'm telling you, this man can work miracles. I've seen him do it with clients. That starts with that. Then comes the pre-approval letter. Then you go shopping. And again, you can, call us if you need some help on getting the down payment side of it ready, etc. As I mentioned. And then you're ready to go. Then you get into the game and start hopefully building wealth, with the home. So there are many ways. You have to put the team together and you have to have the desire to make it happen. It really is that simple.
Knowledge is power.
Yeah, exactly. Yeah. All right. We'll come back with more points under what to do right now on the lending side of things with Dwight. Let's wrap it up with Kristen Snow, the Right Now Traffic Center. Hello, Kristen. We're back at the Jon Sanchez Show on News Talk KOH. Mr. Millard, Highlands Mortgage, phone number, sir.
Absolutely. 775-240-2022.
Beautiful. And Cory's phone number, 775-673-6700. All right, we're talking about, again, what you need to be doing as a buyer and a seller to get ready for 2026. We think it's, at least I do, I'll go on a limb. I think it's going to be a great year next year with rates coming down and many other factors coming into play. So we're trying to get you ready. All right. So let's go over again to recap on Dwight's side of things. Get the credit ready early. Again, these small fixes today can mean tens of thousands of dollars of savings and interest later. Build optionality, figure out the cash side of things. How are you going to come up with a down payment? Where's it going to come from, et cetera? Flexibility, get the pre-approval, right? You're not going to be able to get anybody to take you serious if you don't walk into the deal with a pre-approval letter. Dwight, I love your next point. Don't wait for the perfect rate. Man, we can make a song out of that. Don't wait for the perfect rate.
You'll never get it, John. I mean, it's
right.
usually dumb luck, God's grace, or both. I don't know.
Yeah.
The problem is that if you're trying to time that, it affects your decision making and all that. You can always refinance. And I had this conversation today. Rates went way up and home prices didn't come down. So what makes you think if rates go down, home prices are going to come down? It's just I think you'll get more demand and demand. Law of economics, basic law of economics, supply and demand. If you get a greater demand for housing over and above what you have with rates coming down.
That is a great point, Dwight. And that could be the absolute worst case scenario, right? Next year, if we're right on our predictions, rates come down, demand skyrockets, home builders, existing homes, et cetera, everybody's raising their prices, and you can't get into a mortgage professional because everybody's so doggone busy. Again, folks, I can't tell you enough. 30,000 fewer people are in Dwight's industry. 30,000 fewer people. So think about that for just a second. That's why we're telling you, get things ready if you're going to be a buyer or seller next year. Yeah, yeah, you're right, Dwight. And let's assume again, I don't think it's going out on a limb to assume this, that we're not going to see a big pullback in mortgage rates, right? Even though we're going to get two Fed cuts in our prediction. Again, we're not seeing mortgage rates buzz on that. So,
you're starting to see some migration now. You're starting to see people move, John. I mean, they just are tired of waiting. They need to move closer to the grandkids, whatever life is happening. And they just finally said, hey, I got to start making them.
All right. Well, I'm going to trademark this, Dwight. Don't wait for the perfect rate. So we can put that on your
That's right.
Your website, everything.
That's right.
All right. Your next point, understand affordability, not just price.
Yeah. Don't get fixated on the interest rate, John. I mean, there's a lot that goes to that. There's the principal, interest, insurance, property taxes, HOA, all that. Figure out what you believe you're comfortable with affordability. I'll support it. I'll back it up, verify it. But you're the one that's got to make the monthly payment. Whether the system approves you or not, you still got to make the monthly payment.
Do it. You're right. Yeah. And your last one, have a strategy.
Yeah. Buy now or refinance later. Wait for you and I talked about earlier. I'd buy now if the terms work for you. And if you have an opportunity to refinance down the line and take advantage of a lower rate, then so be it. But don't pass opportunities up right now. They're handed to you right now. There are some incredible bargains and deals out there right now for the right situation.
And folks, Dwight and Cory can run the numbers. If you are able to find that, I'll use the term, that dream home, or it doesn't have to be a dream home, but that home that you want, and you're going, oh, wait a minute here, mortgage rates are 6.25%. I'm going to wait till they drop to 6. Guess what? The savings that you can get on some of these incentives and things that Dwight and Cory are talking about will far outweigh waiting from 6 or going from 6.25 rate to 6%. If you even get that, right? We just don't even know if you're going to get that, right, Dwight?
John, how many would have, could have, should have we've had in our past, right? So absolutely. If you like it and it fits your needs, there's no sense in not taking advantage of it right now.
Dwight, I'm going to wrap up with the final words. Think about this, folks. Real estate rewards preparedness. It does not reward not predicting. It rewards preparedness, not no preparedness, right? You've got to be ready for 2026. The winners next year are going to be the people who position themselves well now, 2025. Get a hold of Dwight, get a hold of Cory. They can help you run the credit, do everything, and make 2026 that great year that you finally get involved in the real estate or move up, whatever you want to do. Just make those real estate dreams come true. Great job, buddy. We'll see everybody on tomorrow. I'll see you on Thursday, Dwight. God bless. Have a great afternoon.
Dwight Millard, NMLS ID number 241259, a licensed mortgage loan officer with Highlands Residential Mortgage Limited and Equal Housing Lender. NMLS ID number 134871. The information shared on this live broadcast is for general information purposes only and does not constitute financial or mortgage advice. Listeners should consult directly with a licensed mortgage professional for guidance tailored to their specific situation. All loans are subject to credit approval and program guidelines. Not all applicants will qualify. Loan terms and availability may vary by state and are subject to change without notice. Highlands Residential Mortgage Limited is licensed in multiple states. For a full list of state licenses and disclosures, please visit https://www.highlandsmortgage.com/licenses/. The views expressed during this program are their own and do not necessarily reflect those of Highlands Residential Mortgage Limited.